If you had $2.22 and I offered to buy it from you for $2.47, would you take the trade? The profit is small, but it's a profit, right? What if I offered to repeat that same trade 38,946,040 times? Would that make it more appealing? The profit on each trade is only 25 cents, and to save you doing the mental arithmetic, if we repeated that trade 38.9 million times, you would generate a profit of $9.9 million. $9.9 million is appealing, right? Well, that's the trade we are looking at today, and assuming you're watching this video around the time it's published, it's a trade open to everyone. We'll have a quick run-through of the background of this opportunity and then get into the numbers. I hope you find the video useful, and if you do, I would be grateful if you would like the video and subscribed to the channel. The Gulf Investment Fund, a closed-end investment fund listed on the London Stock Exchange, is offering to buy back its own shares at their net asset value. The fund was established in 2007 to generate long-term capital growth and dividend income from investing in companies listed, and soon to be listed, on the stock exchanges of the countries that make up the Gulf Cooperation Council region, namely Saudi Arabia, United Arab Emirates, Qatar, Bahrain, Kuwait, and Oman. The fund now has assets of approximately $97 million and pays a semi-annual dividend which, at today's prices, gives a yield of about 4%. The quirk here is that, despite having about $97 million in assets, the market capitalization of the fund is less than $90 million. The officers of the Gulf Investment Fund have therefore decided to initiate a tender offer to reduce the number of shares outstanding and close the gap between the net asset value per share and the spot price per share, and interestingly, they are willing to retire all 38.9 million shares to achieve this. For the uninitiated, a tender offer is basically a public offer to buy shares in a company directly from the shareholders. The Securities and Exchange Commission defines a tender offer as a public bid for stockholders to sell their stock. Typically, a tender offer is commenced for the company making the offer. The bidder places a summary advertisement or tombstone in a major national newspaper, and the offer to purchase is printed and mailed to the target company's stockholders. A tender offer must comply with the rules and regulations, which include certain disclosure requirements, minimum offering periods, withdrawal rights, manner of publication, and other requirements. The details for the Gulf Investment Fund, which I'll provide a link to in the details below, state: the tender offer opens on the 21st of August 2024, closes on the 12th of September 2024, with a payout to tendering shareholders on or around the 17th of September 2024. The tender price paid will be determined once the company's assets have been allocated between the continuing pool and the tender pool. The assets contained in the tender pool have been fully realized and all the liabilities, including the costs of the proposals to be borne by the tender pool, have been accounted for. The estimated costs for the tender pool are $50,000, and the fund has capped the costs at 5% of the realized value of the assets of the tender pool. The last published net asset valuation of the fund, before I publish this video, is the 3rd of September 2024. The net asset value is provided as $2.04,747. I'll provide a link to these details in the description below. So, now we have all the details we need, we can look at the numbers to see what an investor can expect to earn from participation in this tender offer. The mechanics are perfectly simple. An investor takes a long position in the Gulf Investment Fund at the spot price, which is currently $2.22, submits the claim to Gulf Investment to participate in the tender offer, and then, on or around the 17th of September, they receive their cash payment relative to the net asset value per share, currently $2.04,747. By participating in this trade, an investor can expect a return of 11.48%, which translates to an annual return of 299.25%. The risk-adjusted return, because of the certainty of the tender closing and the limited downside price, is high at 263.15%. The expected loss, should you forget to submit your claim to the tender pool, and then the share price dips, is 16.21%. Please don't do that. Always remember to submit your details to claim the money. Given the certainty surrounding such tender offers, resulting in a very slim chance of experiencing a loss, many investors chose to employ leverage to boost returns. Should an investor use 50% leverage in the above position, they can expect a return of 22.76%, or an annualized 593.5%. This translates to a risk-adjusted return of 521.55%. These are certainly appealing numbers. However, the quick-witted among you will have already shouted at your screen that we previously noted the company can apply up to a 5% fee to the tender price to cover costs, and that will obviously affect the expected return. So, if we recalculate the returns profile and assume the maximum cost of 5% is incurred, with all other deal metrics remaining the same, we can see the low-end estimate. Subtracting 5% from the net asset value of $2.04,747 results in a net tender price of $2.03,510. The purchase price and holding period remain the same. In this instance, an investor can expect a return of 5.9%, which translates to an annual return of 153.93%. The risk-adjusted return also remains high at 125.1%. I've also put on screen the expected return numbers should an investor apply 50% leverage. So this trade really is as simple as selling $2.22 for $2.47. But, as is always the case, there are potential pitfalls of which an investor needs to be aware. The first is the purchase price. It should be fairly obvious that you need to buy shares in the fund below the net asset value, ideally far below, otherwise you are guaranteed to lose money. The second potential pitfall is much more difficult to manage. You will need to own shares in the fund for approximately 14 days, and frankly, anything could happen in that time frame. It is possible there will be a stock market correction or even a problem at one or more of the companies held in the fund. This will obviously reduce the net asset value per share for the fund, possibly below the price paid, and, again, the investor would suffer a loss of capital. Finally, if a significant number of shareholders chose to sell their position in this tender offer, the Gulf Investment Fund will be compelled to sell the shares in their portfolio companies in order to cash out everyone, and this selling could force down the price of the portfolio companies and reduce the realized value. This would again put a downward pressure on the net asset value of the portfolio and depress the expected return. Even in deals like this, there is the risk in risk arbitrage. What do you guys think of this takeover? Let me know in the comments, and don't forget to like and follow if you found this video useful. Be aware that all the figures mentioned are at the date of my calculations and will change in line with the share price of the company, any change to the takeover price, and the duration to close. As always, this information is provided for educational purposes only. You should not consider anything in this video to be investment or financial advice, nor a recommendation or endorsement to buy or sell any financial instrument. You should always conduct your own research before considering any investment and seek independent financial advice. Thank you, and until next time, enjoy life.